This past week has been an object lesson in the power of the bond market. And not for the first time, a favourite quote on markets comes from the former CEO of Citicorp, Walter Ritson, who observed that capital goes where it is welcome and stays where it is well treated. Remember those words. I made shows through the week about the fallout from the Trump tariffs and the subsequent 90-day pause of the reciprocal tariffs, and then the extra hikes directed at China and China's escalation back. Beijing increased its targets on US imports to 125% on Friday after Trump's move to hike duties on Chinese goods, and the turmoil on financial markets, especially a significant sell down in US treasuries. This lifted yields. Remember, bond prices and yields move in opposite directions, with the 10-year up 12.4% across the week to 4.494, while the 2-year was up 9.07% to 3.970, and the long 30-year was up a massive 10.39% across the week, even though selling partially reversed as the Friday session progressed. This is not normal. Rumours went around it was China or Japan selling bonds, but more likely it was driven by hedge funds caught out of position. Until treasuries stabilise and start to behave normally, risk assets will struggle, Barclays analysts wrote in a note on Friday. Normally, bond markets, though a huge element in the financial system, do not make moves of this scale. After all, they're meant to be the safe, secure, boring backstop to the financial system. Macro commentator James Aitken told his clients, financial history reminds us that when a policymaker tells hyper-financialized markets he or she is not targeting markets, markets will force the policymakers to target them. Indeed. Like it or not, the bond markets matter.